Hi, this is Joseph. Today is Monday. It's April 4th. This is a trade copier update. So I had two trades so far. They were executed just shortly after the London session open. I'll walk you through them quickly here to show you what I was doing. This is the first one, euro dollar, paid 35 pips on this one. This is the 1 hour time frame, so I'll walk you through it. So I'll show you what I was doing here. This is the market open right here where I'm moving my cursor. And I went between the 1 hour chart and the 5 minute chart to pinpoint the entry. So I'll go to sorry about that. I'll go to a 5 minute chart here in just a moment and it'll switch over. And then we'll detach, slide it over, and you can see here where it sort of collapsed. So I had a range of consolidation here, and I was just watching the bars. I do an exercise with my coaching clients as well, and I teach them how to count. I call it counting the waves. That's the exercise that we do. And basically, what I'm doing is counting these waves and the activity along with volume. Now, this is the MetaTrader. I execute the trades off of the MetaTrader platform. But I also use another chart I'm going to show you here in just a moment, and I'm using futures volume. So I'm watching the euro futures, and I can calculate the same thing. It's the exact same movement, the same time frame, and I can see where supply or demand is coming back in, or if it's weak at whatever stage, depending on which direction I'm trading it in. So I have a range of consolidation. I've got my buying climax, automatic reaction, ranges of consolidation. We refer to them as accumulation or distribution. So in this case, it's going to be a short-term range of distribution. Distribution meaning that it's a range of consolidation up at the highs, and then accumulation is a consolidation range down at the lows. A lot of people aren't familiar with those terms, but just to give you an idea of what I'm doing. And then I'm basically watching the activity. And at some point, in most cases with distribution, we're going to get an upthrust and then some testing, and then we finally get the reversal. And this testing right here and these upthrusts are done for a very specific reason. It is the smart money that's testing to make sure that the market is really ready to roll over at that point and then start to make its move to the downside. So here you can see again, it's starting to roll over. I go to a 30-minute or a 1 hour time frame to confirm what I'm looking at, and then I'm able to get my entry here. My entry after the test here and a second test was at 35. Excuse me, 35. And then the target was basically the double zero. The double zero meaning right down here at the 1.1000 level. And that's where I got out of the trade. And then I basically did the same thing with the pound dollar. Let me show you the pound dollar. This is pretty much the same setup. This is also the 5 minute time frame. But you can see here I get in at 28 and I close out the trade. My target was again the double zero, but I get out here at 97. So this between these two trades, I earned 65 pips this morning. Now that's not double counting. I know a lot of people, a lot of other services, they'll double count. If they put on 2 lots or 5 lots or 10 lots, they'll call it 200 or 300 pips or something like that. I don't think that that's very accurate. What I want you to see is the distance from the entry to the final targets. It gives you a better idea of what you could expect to earn because you're going to be using a different lot size if you use the trade copier. So again, this one paid 30 pips. The euro dollar paid 35 pips. And then at that point, I can see the reversal. I let the market tell me when to get out of the trade. I read the markets based on the activity, the volume, and then the bars. So I really don't rely on too many indicators. It's kind of silly to rely on indicators and thinking that that's the way trading is. That's not that's usually what gets people into trouble. They start using the MACD or stochastics and things like that, and basically they start looking at tops like this. And if you use an indicator like that and you don't read it correctly, a lot of people will try to buy at the tops and they get stuck and they don't understand what's going on here. And I've been doing this for 22 years, and this is exactly what I'm looking for. Basically the same patterns, the same setups. They don't always look like this every single day, but it is basically the same procedure, just reading the markets, understanding supply and demand, and then following this, and tracking the footprint of smart money using volume. So I'll show you my volume chart here. This was actually the pound dollar when it rolled over here. And again, I'll walk you through quickly here what I was looking at. So I've got a top. This was actually my buying climax here at that point. There was another area of resistance right here. And then when I noticed that none of these bars were really closing above that level of resistance right here, there's my upthrust and there's the test. One bar closes above and then rolls right back over. And then I start watching the tests. Now the tests in themselves are confirmation that price is likely to continue to move down lower. Testing is positive. It is what we need so that we can confirm, and then I'm watching volume. This is actually true pound futures volume, not tick volume. It's not the same thing that you see with the MetaTrader. So that's exactly how I was able to execute these two trades here. Now I'm just waiting to see if there's going to be another opportunity during the New York session. But so far, we've earned 65 pips.